I guess we can get started here, and then people I'm sure will join. But I just wanted to say good afternoon and thank everybody that's on. I know there's a lot of other things going on, so I think just taking an hour or so for a webinar probably works out pretty good for this topic. For those of you who don't know me, I'm Lee Hutchinson, Assistant Vice President with Farm Credit Services. And so I know there's quite a few of you that I've met before that were on the list here, but anyway, thanks a lot for your business, and we appreciate you attending this. A couple other things I did want to touch on before I introduce our speaker. We do have coming up the Farm Women's Forum on April 14th, and so we'd like to have RSVPs in for that event by next Monday, which is April 5th. And you can RSVP by calling your local branch, or you can go through our website and register directly from there. Another item that's, I guess, been a big topic, I guess, and a big part of what we've been doing the last few months, but the payroll protection program that I think everybody is familiar with now, the deadline was extended. A lot of you probably heard that as well. And so the new deadline is May 31st. Most producers, I think, have went through the first draw application already. There is a second draw potentially available to producers who qualify. And the first step in that process is figuring out if you have a 25% loss year over year in one quarter of 2020 versus 2019. So if your revenue dropped in one quarter of 2020 compared to the same quarter in the previous year. And if you have any questions on the program, contact your local branch and loan officer and they'll help you work through it. But there is that extra eligibility attachment with the second draw applications. And it's also, the deadline, I guess, would be subject also to the funding running out early, I guess. In 2020, there was some additional funding that was reappropriated when the program ran out. There's no way to know for certain if that'll happen again. So keep that in mind as you're working through those. So with that, I'll move on to our main attraction here. Dwayne Bussey has been kind enough to put this on for us. And so Dwayne is a founding member of Bolt Marketing LLC, which is a commodity brokerage firm in Northeast South Dakota. He specializes in risk management for farming operations, offering insurance and marketing strategies. And he is also a partner in Bussey State Line Farms, which farms in South Dakota, North Dakota, and Minnesota. You're right in that corner, right?
Right. Mm-hmm.
You graduated from South Dakota State in 2001, I believe, with
yes.
in ag. And so you started out as a branch for Lakes Trading.
Mm-hmm.
And after that, you started the Bussey State Line Farms, which I'm assuming is a family operation. So I'll let you talk more about that. But thanks a lot, Dwayne.
Yeah, no, hey, thanks for having me. Glad to be here. Always fun talking markets, cattle, corn, soybeans. Interesting day today, as you can imagine, in a brokerage firm. A big report, which we'll go over that. But yeah, I did go to South Dakota State. Hopefully nobody up there holds that against me. But you guys whoop up on us in football all the time anyway, so I don't think I can really claim anything there. But I'm hoping to have a football game this weekend versus NDSU over there, but we'll see if that happens or not. So anyway, yeah, grew up right in this area, went to South Dakota State. While I was there, I had an interest in marketing. Coming back to the farm and listening to my dad talk with his broker, I kind of thought, actually, marketing sounded very interesting to me, so I started taking more classes in the marketing side of it and actually got my Series 3 license while at college. So I was ready to go when I got back home and started this small company as a branch office called Lakes Trading, and thought it was going to be just kind of something to do on the side, but there's enough demand for brokers and hedgers that kind of got me planted in here in this office that you see on the screen there more. But luckily with technology, I'm still managing to get out and farm a lot. And just get on the tractor and put a couple iPads next to me and a laptop computer in case I need something, and away we go. But not in the field out here yet, but pretty soon. So, yeah, I don't know. I guess we'll go ahead and get started if that's right with you, Lee.
Yeah, that sounds great. I guess one other thing I forgot to mention is if there's any questions as we go along here, just type them into the Q&A or chat. And I think at the end of each area, we're probably going to have some time for questions, but I believe everybody is muted. So if you have a question, that's probably going to be the best way.
Yeah, I'm glad you brought that up, Lee. Yeah, instead of me talking straight through for a presentation, Lee had the great idea to stop after we talked the cattle market and ask for questions. And yeah, sadly, you'll have to type them into the Q&A, but I found a lot of other Zoom meetings and webinars, people actually prefer that. That way they can kind of type in and they don't have to speak up. And then we don't get any background noise either going on, and any embarrassing stories later on about who didn't know that they were on mute. So we'll go with it this way. So yeah, without any further ado, I'll kind of start going here. I'll review today's report a little bit. We'll look into the fat cattle market, and that'll dive right into the feeder cattle outlook as well, and what I'm thinking for that cow-calf producer this fall. We'll go into some cattle marketing strategies as well. Puts, calls, straight futures, things. You can also talk to Farm Credit right there about the LRPs, the insurance side of things for cattle as well. We'll go into spring wheat outlook. I wouldn't be surprised if there's some guys listening right now that are out planting spring wheat. I know in our area, people are starting to scratch around too. Soybean outlook, corn outlook, and then hedging markets and a few things I've learned over the couple of years. Yeah, sadly, been doing this, not sadly, but blessed to be doing this already 20 plus years, this marketing side of things. So not the young pup I used to be in this business anymore, but this business keeps everybody kind of young and moving, that's for sure. So let's look at the report today. This was the March planting intentions report, this side of it. And that's where the surprise came from today. Corn acres, USDA came out with 91.144 million acres. Average trade guess was 93. I have to cop up and say my estimate was 95. I just thought with the high $5 corn we had this last fall, we're going to see a lot of corn planted. It's important to remember after a day like today, it's a lot of fun. You close up limit, but those are planting intentions. Lee and I talked before we started the presentation about that's the fun thing about being in the Dakotas is our planting intentions can literally change after they give us the planting intentions report. So I do look for those corn acres to be higher at the end of June, but we'll talk more about that into the report. For soybeans, less acres than intended too. Look at that, 87.6. Really, most of the trade was talking anything under 90 was going to be bullish for soybeans, and we had a bullish reaction today, up 70-cent limit. We're placing orders to try to buy beans tonight because I think it's going to continue to keep going higher. I don't see why not here. It might have to ration some demand. All wheat was a little bit of the bearish side of things. Poor wheat guys, right? It always seems to come down to the wheat in these USDA reports. A little bit more winter wheat acres, actually quite a bit more at 33 million versus the 31.8 estimated. So when you got spring wheat at 11.7, that was very close to the trade estimate. Some were calling it for lower. I actually thought we'd be close to last year's number at 12.25. Reason being, great weather. If you're going to plant spring wheat, you want to plant it early. And I think the guys who still have it in the rotation down my area are going to keep it in the rotation. So that spring wheat acres could actually go up by the time you get to June 30th. I should mention that. So today was the planting intentions report. June 30th, USDA will announce what they actually believe the total acres to be. That's after we're reporting FSA, of course. So when you add up all those wheat acres, those different classes, you end up with that 46 million. So quite a bit more than the trade was expecting. But of course, wheat still traded up about 16 cents today, following corn and soybeans that were lock limit up. Don't really have to talk much about the cotton. I know in North and South Dakota, but those acres were about steady. Should maybe mention, the oats was lower than anticipated. That was lower than what I thought too. I thought we'd cross the 3 million mark for oat acres, but we will see there too. Like I said, it's really good weather. They do have increases in acres for corn and soybeans for North Dakota, of course. Huge amount of prevent plant. We'll see. I think we might find more acres by June 30th. That'll definitely be something I'll be saying as we go through this presentation. On the quarterly stocks report, not a lot of surprises there. Wheat stocks 1.314 billion versus trade guess of 1.27. So that's a little bit bearish there. Maybe we're not quite feeding as much wheat as we thought. Maybe USDA is saying we had more wheat, a little bit bigger yield last year than currently estimated. This was the bullish one here, was the corn stocks, down about, what, 66 million bushels there. It's not that 60 million bushels is a lot, but it's a third consecutive quarterly stocks report in a row where USDA dropped the stocks. As you know, last year they decreased the 2019 crop size, and maybe even the 2018. We're not sure what crop year they decreased, but maybe that's still happening here. Or maybe feed demand is a little bit higher than anticipated. Remember, we had really heavy carcass weights in steers, so maybe we just fed them more than the trade was anticipating. Soybean stocks just a little bit bearish, but pretty much right in the trade estimate at 1.5 billion. So not a big surprise there. To summarize the report today, and sadly, as you guys probably know, I could talk for 20 or 30 minutes about just the report, but let me try to summarize it and get to the rest of the presentation. It would have been more bullish if we had friendlier stocks report, if we decrease the stocks, because the stocks report is the old crop. If they take those bushels off, like the 60 million we lost from corn, that's just gone. Comes right off the top. The planting intentions, it's nice that the acres were lower than anticipated. It gave for a really big reaction. But as the smoke clears and the dust settles a little bit, we'll learn that those can still change, of course. So I would have rather seen a quarterly stocks report bullish than the acreage, but hey, whenever we're up limit, you're not going to see this farmer complain. So that's the report there. We'll go right into the livestock market and a fun market. You're going to find out that I'm pretty friendly to this livestock market here as we go. This is a look at continuous live cattle. Great rally from the COVID low down here. We're trading around that 120 before COVID hit. And then of course we dropped about $46 per hundredweight, all the way down to $81 here. Packing plant employees started to get sick, of course. Then other ones were just afraid to come to work. And remember that packing plants ended up shutting down. This created less demand for the cash cattle and ended up being a real big spike in the box beef market, of course. But we're getting to some interesting levels now where, you know, we're right back to where we were last year when I drew some downward trend lines off the top. So if we can break that, we break this formation we've got here. Very technical talk, but something that looks good. At the same time, the funds actually liquidated a lot of positions, their contracts. You can see the arrow right there. That's when COVID basically hit. The funds were long this market. And when they went to get out, brokers like me, you know, small traders, we were too nervous to buy the live cattle market, even though we thought, well, people are still going to eat, right? But when the funds are liquidated, you're down limit for a couple of days, it makes you pretty nervous. And quite simply, at times, there's just more sellers than buyers, guys, especially when you talk about this cattle market. Funds started playing this cattle market back in 2010, as you can see, and that really moved our market then. And now they've stayed in it. You know, this isn't corn and soybeans. You know, cattle, you know, the lead contract might trade 20,000 contracts in a day, but the funds are still large players, where corn can trade 240,000 contracts in a day in just one contract. So the funds learned back in 2010 that they can play this market, maybe manipulated it just a little bit. So when they decide to sell and get out, they're going to move the market. So if you're a cattle producer, cow calf, or feedlot, this is the chart you kind of want to know where their managed money is at. Every week this will come out. So yeah, keep an eye on that. There was a big fundamental movement as well, right? The cattle started to get very huge too, and I'll show that in the upcoming slides as well. This is a look at June live cattle. We went from 120 down to about $80 per hundredweight. Like I said, the funds were liquidating their positions. Everyone was afraid to buy. Same thing happened when crude oil went negative, basically, guys. And probably don't have to tell any of you guys up in North Dakota what happens with crude oil when it goes negative. I was worried that'd be the one time on my farm I'd find crude oil somewhere, right? Have to pay somebody to take it. But markets actually can go negative. We watched a guy trade crude oil that day that sold it for a penny and actually got out for a profit that day. So interesting times there. When COVID did hit, we did have some fundamentals change as well. But that was more of a man-made problem due to the slow packer processing. Take a look at the previous year's chart here. That's this chart I'm showing here. When the packers started to shut down, of course, beef production, that's what this chart is, started to fall off a cliff. And when that fell off a cliff, then you had box beef go sharply higher. Here's a look at the box beef right there. Box beef cutouts went sharply higher because we weren't processing the cattle. Demand was a little, no, demand wasn't sketchy actually. It was about like the toilet paper fear, right? We were out there buying toilet paper and red meat and stocking our freezers. That's why the box beef prices went so high. Steer weights increased during May and June when they seasonally should have been decreasing. This brought on a huge problem in the cattle market last year. Look at this right here is what I'm talking about. See how the weights increased last year and when the seasonal tendency is to be way down here. We at one point were 50 pounds heavier per steer carcass. Okay, 50 pounds sounds like a lot. Now think about how many animals are slaughtered in a week. That's about 30 million more pounds of product we had to move just because of the heavier carcasses. That alone, that's a lot of extra meat to move. And this began a very long tail process, a problem, I should say. Because what started to happen then, so packers, of course, would close down for a while. Then they start to come back in, they start processing meat. Okay, that's good. But then they went to go buy cattle in the feedlot, they were backed up, right? So they were heavy. Packers aren't idiots, right? What they would do is they'd look at these cattle on the show list, and the guy who just put his cattle on the show list to sell this week, those cattle are current, he wouldn't even give them a bid for about 3 weeks. Let them sit there for 3 weeks, get nervous, and then I hear from all my feedlot guys, well, I had to sell this week because they just have to move, they're getting heavy. And so they hit that early Tuesday morning lower cash bid, right? And any of you guys that have been out there trying to sell fats before, you're always upset at somebody hitting the early Tuesday morning bid. Well, because these steers were heavy, that happened quite often. And that happened for almost a year straight. And then the weight started to come back in line. Because of these heavier weights, you just had a lower cash market than anticipated. The cattle were backed up in feedlots and packers kept control of that cash market. Like I said, they're smart and maybe a little bit greedy at times. They wouldn't bid on the show list right away, so they put them out there longer. This is a look at February and April live cattle spread. So the spread between the two contracts, right? Normally, February is trading at a premium to April. Spread traders tend to buy it around here. It's a nice seasonal trade, rallies up. I did as well, thinking, well, this is very cheap. It's got to go higher. Will it continue to go lower? Because as we got into 2021, we're bullish longer term, right? We're going to start to get out again. We're going to start to take vacations. We're going to start to eat out at restaurants. And that's very true eventually. But in the short term, the cash market's still down. So that makes the February contract dip below the April contract. So it's trading at a negative number. Here's a look at the April-June live cattle spread as it sits now. June never goes premium to April. I shouldn't say never. Never say never on any markets, to be honest with you. It's rare, but this year it has gone negative. Maybe found a bottom as the cash market finally started to come up here over the last 2 weeks, just a couple of dollars anyway. So I think we're finally getting current here now. April live cattle usually trade at a discount to the cash market. Of course, today, what do we end up with? April live cattle at 121 basically. Tomorrow the options will expire there. That's important to know too. So we'll get into delivery very soon. But April is trading at quite a premium to the cash market. We'll see if that cash market can flip and go to a positive basis. Might be a bit of a stretch, but we'll see here in coming weeks. So let me get back to that chart that was the steer weights. Now look at the current year, we recently had a big drop in weights, finally. So we had that long tail problem I talked about by the heavier carcasses. And the packers kept it that way because they're a little bit greedy and because they can. They just shoved the guys back in the show list until they became a heavyweight problem. These couple of weeks right here, we lost 20 pounds per carcass, 10 pounds each week. That was big. That was where I got friendly to this cattle market and said, finally, we're not going to have this hanging over us anymore. That's going to be a big game changer from here moving forward, too. That's why the cattle market is getting much more bullish now. Here's a look at slaughter. That's beginning to drop back down now, thank goodness. If you look at this year's chart instead of last year's where we really fell apart, we're still got very high inventory numbers. So slaughter is still high, and it's not going to just fall apart, but demand seems to be very strong. We could have what I'm thinking is like a snowball effect here. Now that we've got the lower weights coming in, we're going to have lower production. Lower production is going to equal higher box beef prices. Yesterday, choice box beef was up $5 per hundredweight. We're in that 244 area now, historically high for this time of year, maybe even a record high. I think we go to 250. Higher box beef prices then equal a higher demand for cash cattle, right? And the higher cash cattle market for fats eventually equals a higher feeder cattle price this fall, maybe even sharply higher. So don't be too worried about today's pull down. This is just kind of a look at beef consumption. We're well off the old highs. You know, it used to be everyone ate more meat. But the nice thing is we are coming off the 2014, 2015 lows as well. COVID, I think, is helping this, actually, believe it or not. I need to stop and say I'm really surprised at how the cattle market performed last year. I know we had the horrible spike lower, right? If you lost money feeding cattle yesterday, last year, you're asking me why. I'm talking about how good it was last year. But what I was taught, being a broker, is that all the meat we produce in the Midwest, you know, it's corn-fed, they're high quality, high marbling, that's going to get slaughtered and go to the East and West Coast and be fed in the restaurants, right? So when restaurants shut down, I thought, this is going to be just horrible. Now, yes, people still need to eat. I think what people did is they learned how to cook at home a little bit. Now, us in the Midwest think, you know, what are you talking about? But believe it or not, in the cities, a lot of people eat out all the time. And I think they learned how to cook a good steak at home. So I think when we get through COVID, the restaurants open back up, we'll still have that restaurant demand that we've always had. But now I think we're going to have something else. We're going to have, you know, maybe the family dinner demand a little bit stronger than we've had before. So that's why I kind of wanted to bring that up. This is a look. USDA, like they do reports for grains, right? Every month they list quarterly beef production. Now, we always usually give USDA a hard time, right? But this is a really hard report to do, but they're giving their best shot at the quarterly production for each quarter. So for 2021, they're looking at pretty close to the same beef production. In the second quarter here now entering, they're looking for a sharp rebound off of last year. No big surprise there, right? Remember, we didn't slaughter as many animals last year when packing plants were shut down. Still fairly high beef production. So as bullish as I'm going to talk about cattle here now, we need demand to stay very strong because otherwise we have plenty of inventory. Third quarter is where it starts to get interesting, guys. We start to see a decrease in production. And that's from some herd liquidation last year, just more people getting out of the business, more urban sprawl too, just less pasture area. So this is why I start to get a little friendly. Now, it's USDA's best guess, but at least they're not guessing it higher, right? And then when you get to the fourth quarter, they see production down quite a bit. So as we have less numbers out there in production down, if we can stay current in this market, I see really bullish things in the cattle market moving forward. But we do still have a lot of cattle currently on feed. There's no doubt about that. But like I said, as long as we can stay current and get through them, that's the problem. Always watch those carcass weights. That's a huge thing for me. Let's look at April live cattle. I think we closed very close to there today. I didn't update this chart. I'm sorry. We did hit 125 a month ago. And if you look at continuous April live cattle, so every line here is a new year. You can see 2018, 19, 20. We've always hit 125 for the last several years, and this year was no different. It took a while. We had to come from kind of the depths of hell, excuse my language, but to get up to 125, we had to rally quite a bit. We did see it. To get April to 125 before expiration, we're going to need that snowball I talked about before, lower weights, lower production, higher box beef, higher cash price. We're going to need that to be more of an avalanche than a snowball, I'd say. But it's the June contract I'm excited about getting well above 125. Here's a look at the June live cattle contract. Before I go into kind of where I think that can go, I was going to just bring up another technical thing just to continue to help teach different things that brokers are looking at. These bars here that go sideways, that's a volume profile. I recently have been watching them much more to help trade. What happens is, if you look around this 116 area, go straight across. When we got up to 116, we didn't gap through it, but we spiked through it rather quickly. That produced what we call in the business single prints. So we just didn't have a lot of volume there. We kept trading away, right? Everything's good. And then we started to pull back here. This was a couple of weeks ago on a Thursday, Friday. I have this nice upward trend line, which I'm sure a lot of you guys have talked about trend lines and that. You see those on charts as well. I was concerned if we break that trend line, I was targeting a pullback to that 116 area. Just like trades like to fill gaps, they also like to go back and trade in these areas that there wasn't a lot of volume. So just a little side technical point I guess I wanted to bring up. Looking now at June live cattle at a little bit bigger picture here. Obviously you see we came off the COVID lows. I do think we get above 125. That's why I got that red line drawn in there. It'll be a little bit of resistance from back in the 2019 contract high, but I think we can get there. It's going to take staying current, keeping demand high. Obviously, wanted to bring up this again. We are looking at a large forecasted increase, but remember, it shouldn't be that alarming of an increase if it wasn't for last year. All right, continuous August live cattle chart. This is look at August live cattle, what we've got so far. We're at 121. I think we can get up to that 127.65. Can we bust through that resistance and hit 130 for August? I think it's very possible. I have cutouts going sharply higher. Really when you look at corn, soybeans, even wheat to some extent, cattle is the only market that hasn't really taken off yet. As far as this whole inflation fears and things like that. So I think we can get up there. But when I stop and think about February expiring in the low 120s, April struggling to get up to 120, and I think your August is going to run up to 125. That sounds a little ridiculous, but compared to spreads. But like I said, with us opening up again, vaccines going. I talked to a broker recently on another show in the afternoon, a radio show, and he mentioned that it could be like the roaring 20s. People have got the stimulus checks. They're excited to get out, excited to take vacations. I think he's right. It could be a little bit of the booming 1920s again. So, and here's another thing is I've had some packers tell me do not be short the August live cattle contracts. Now, could they be setting me up? Sure, they sure could be, but I don't think they are. I agree. The fundamentals look bullish to me, and I think we're in the 130s by the time we get there. But will high-priced corn affect live cattle? Well, yes, obviously it will. But when you look back to when we've been this high, it's also when corn prices were high too. This is look at continuous corn chart. Corn took off in 2011, and then of course 2012 we had the drought, so we were at high-priced corn. Now, if I jump back and look at the cattle, oops, maybe went too far. No, I didn't. That's April cattle. We started a rally in 2010, 2011, the same time corn prices did. It takes a little bit of time, right? Your input costs increase right away, so maybe you don't make as many dollars on the current pen you're feeding, but eventually high-priced corn does equal high-priced cattle. Feeders, kind of the same way. Now there it takes a while, right? Because at first, high-priced corn is going to make everyone say, "Well, I don't want to buy those feeders." But once they can make money on their fat cattle, then it in turn will spill down to the feeder cattle as well. I mean, gosh, I sure remember this rally to 240. Remember, so corn started to rally in 2011, really rallied in 2012. It took a little while for feeders to feel that same inflation, but as we rally, then we produce more corn, don't we? In the coming years, and that created quite a big spike for the feeder cattle. Never forget that year, because once we got to 170, I remember telling people, you got to sell feeder cattle. It's at a record high. It can't hurt us, right? Never tell the market it can't hurt you, because it can definitely hurt you. All right, this is looking at the managed money positions for the live cattle back again. The funds may have factored greatly in how much we rallied back in 2010 as well. I mean, supply and demand had something to do with it, right? And that's what I'm talking a lot about here today. But look, remember I said funds really figured out that they could play this market back in 2010. And they went from their record long of about 70,000 contracts to over 140,000. So they doubled what they could buy before. So it's a big deal. And now, a little caution to the wind here. Look where live cattle are at, or managed funds are at right now. They're definitely on the long side. They've taken some profits here recently, but if something happened, and always be aware of this, like a pink slime, an afternoon TV show host saying something bad about meat, and the funds decide to liquidate out, well, then our cattle market's going to go down. What I've told people before is, I can look at supply and demand and consumer demand and be pretty good. And I'm going to tell you guys that I think August cattle can be 127, 130. Okay, I'll say that with confidence, but because of the funds manipulate, I don't mean to manipulate's a bad word, but trade this market so heavily. My 130, say, mark for August live cattle, I tell people I can be off by $20. So I'm not a whole lot of help, right? If the funds want to go record long and go to 200,000 contracts long, I guess I'm going to say we could be at 150 for August live cattle. And if the funds exit all the longs and want to go short, which they rarely go short, but short just a little bit, I'm going to take $20 off and say we're around 110. So keep that in mind. Obviously, I think you guys all know by now, brokers don't see and know everything. Otherwise, they wouldn't need clients, right? But the funds and where they're at in your commodity is a very big deal. Watch the fund movement in charts like this just as much as you do the DTN quote screen. Continuous November feeders. Can we see a run to 240 back here like we've got on the left? I don't know. I'm not here to create that much bullishness, but I don't think we're going to have a problem with what has been a resistance line for a long time. We've been at this 160 for quite a while here. As far as been here a while, struggling to get through it. We just are popping through it here yet this week. I think we're going to go well through it this year. I think we're looking at more like between 180 and 190 for feeders this fall. And hey, that's bullish enough, right? I'm not just saying we can get to 160 and we have to buy puts, but so I'm obviously looking for higher price feeders this fall. Hopefully that helps the cow-calf guy a lot. It's been a number of years since we really got back to some really nice profits. Now let's hope we get that rain that Becky was asking me about before the presentation, so we can keep our calves until fall, right? Inflation. All right, everyone's probably heard about it recently, right? Everyone's talking about it. Inflation fears, what could happen? I had another colleague go on another show and talk about $30 beans and like $15 corn, and that got everyone fired up and going. But I know what she was doing. She was just talking about back in the 70s when we had inflation, here's how much commodities went up as a percentage change. And she was just taking that same percentage change into what we have now and just came up with $30 beans. I'm not here to say beans are going to $30. I'll be sold out before it gets there anyway. But I didn't trade back in the 70s, obviously, when we had the last big inflation. But one thing a lot of people have told me is that, when you went out to buy something, it was high priced, but you better buy it that day because tomorrow is going to be even higher. I don't know. if we're going to have inflation, we need the U.S. dollar to start going back the other way. And actually, the U.S. dollar's at a 4-month high today. So maybe the inflation fears are going to get kicked down a little bit further. What the government has done, by printing all this money, is they're counting on that U.S. dollar staying higher. If you print money and the dollar stays high, you're okay. If you print money and the U.S. dollar eventually crashes, then you're going to have raging inflation. So stay tuned on the inflation thing. I wish I knew. When I think of all the money that we printed, not to get into politics this afternoon, but I don't see how we don't have some sort of inflation. But we will see. A lot of stimulus checks out there. Usually extra money equals people buying higher price cuts of meat. So that's a good thing. A few marketing suggestions I've got before we get into a couple questions on the cattle market. What should you do? I get that quite often. Well, I basically talk bullish. So the number one thing everyone's probably going to do is just do nothing and hope that the market rallies. Well, what if you already sold your calves? We're having more and more interest from the cow-calf guys to sell on, say, like a superior market. You go videotape even the newborn calves, or you have videotape from last year's cattle will work, and they can go out and sell for this fall already and negotiate a price. If you already sold your calves, I would buy a November feeder cattle call option back. Rough costs around $5.50 per hundredweight. So that's going to be about $27.50 per contract plus the fees. The contracts are 50,000 pound contracts. What a call option does, of course, is it gives you the right to own November feeders at $160, but not the obligation to sell them there. So you have that right to own it at 160. Market goes to 240 again. We go chase those all-time highs. But of course, you want to own the board at 160 then. So you would take that call option and you could exit it for that profit between the 240 and 160. Once you get profitable, something else, that the price gets profitable for you where you're happier, I should say, you can buy put options then. Now, put option is just the opposite of a call. You buy a floor on the price. So on this example, you buy a 160 put. Then what you do is that as the market goes up, let's say that 160 put costs $550, market goes up. Okay, well, that's good. I just still set floor. You have the right to sell at 160, but not the obligation to you guys. So if the market goes to that 240, let your put expire worthless, you paid $5 per hundredweight, you can still sell your calves on the cash market up at the higher level. The last thing I mentioned here, and I think you already see it, is the rolling up of puts. We've done this a lot more in cattle recently, and I like it. It does start to add up in expense, but it's made for some well-rested nights for some of my feedlot guys and cow-calf guys. So I'm talking bullish cattle here today, right? Everyone's somewhat happy about that. Say the market starts running higher, you bought a 160 put, but because you still want that security, right? You want to make sure in case, that talk show host talks bad about meat again, and we crash to $130 per hundredweight. You don't want to lose out on that $30. But you can roll up puts too as the market goes higher. It continues to rally, say it rallies to 170. You just sell that 160 put there and you buy a 170. Now maybe that 160 put that cost you $5.50, maybe it's only worth $1.50 at the time. And this one's worth $5. Well, so what? You still, net cost of $4, but you gain $10 per hundredweight in a floor price. So you keep rallying those puts, you keep selling the one and then rolling up higher. And then eventually, if the market turns down, you're actually protected at a decent price. Questions on the live cattle market? I'll see if Lee's there yet. There he is.
We do have a couple questions here. I'll ask them if that's all right.
Yeah, please do.
So the first one is, do you think this move with the smaller meat processors, that's basically a mandate, I believe, coming on board, will make a difference, or basically are the big four still going to do business as usual?
Yeah, I was worried somebody would ask about stuff like that. I think it's a great thing. Or the mandatory cash cattle trade. I think, that could help as well. What the gentleman's talking about there is, the large package, right? It's a problem. I talked about how over the whole last year, cash cattle prices basically stayed low because packers, these 4 or 3 packers agreed, hey, let's just stay low and make sure we buy just the real fat ones and keep the shoaless ones on there for 3 weeks till they're fat again. Then they're going to hit that early Tuesday morning bid. When there's only 3 people, it's quite easy to negotiate, isn't it? When there's a whole bunch of them, like if there was this small packer thing could really go, then there's just more negotiation out there, and I think you could get a higher price because somebody's going to be short-handed product and pay more for it. Here's the thing: is that ship's probably already sailed. I think the packers are too big and too large, unless the government's going to come in and do like what they did to Packers Bell, the telephone company, years and years ago, and say, nope, you 3 packers have to now be 20 packers. You need to split off into different companies. That's really the only way I see that really helping. I guess what I tell a lot of people that ask me about packers and how the industry isn't fair, I tell them I totally agree, but I also gonna say get used to it. It's just the way it is. You kind of got to roll with the punches with them. So sorry, I don't think it's going to make a big difference.
The next question was kind of related to that, but do you have any thoughts on the introduction of the Cattle Market Transparency Act?
Right. We were just talking about that the other day in our office. Not as good as you'd like. I mean, it would be good to have more cash cattle trade, but I still think you still have the big problem, right? You still, who are you negotiating with? Just the only 3. And they're very good at negotiating. So now we're going to have more people negotiating cash than we do now if that goes through. Okay, that's great, but they still have power. In fact, there's just a part of me that says, could this work against us? What if, they call one feedlot and they get a couple of at the lowest bid, and of course how social media is, they'll post that 110 bid instead of the market truly being at 118, and then people will see that and then feel like, well, geez, do I have to take the 110? Then they're going to call you, a local guy, and say, well, I already got 110 for some, so you either want to sell them for 111 that I'm offering you, or we'll just talk to you next week, I guess. So I don't know if it works. I know those guys down in the area that help write the bill, and I hope it does work, but I still kind of go back to probably just kind of get used to the packers just own this industry. I'm really close to a small packing plant in Aberdeen, South Dakota that's, tried to get going privately once and publicly once and didn't work, and now it's owned by, of course, a Japanese company again. So, but no, it's tough. I wish I had better news there. I'm hopeful. At least we're doing something.
Right. Maybe in the long term it'll have some impact, but
right.
Probably not huge right off the bat.
Right. Time will tell.
Yep. The next question, which you did comment some on this in a general statement, but what happens to the cattle market if corn goes to $7?
Yep. It stings for a little while. Believe it or not, though, it will make for higher price cattle. Those charts I showed that showed, how high we got back when corn prices were high. That'll happen again here too, especially if it's an inflation thing. And lock in your corn needs for the spring, which is easy for me to say now, right? I'm in an area, and I think you guys are too, where there's a lot of prevent plant. There's just not a lot of corn available. Pump the brakes on the whole corn's going to be just $7 this fall, though. USDA gave us a low acreage number this morning, and what's that going to do? It's going to rally the market. And what does a higher price mean for the spring? It means I get my butt out of the office a little bit earlier and I plant more corn. So I don't know. Corn prices, I think, will be lower by fall, but China's corn demand has changed. Their feed demand has changed. So they're always going to be there buying some of our corn. So get used to higher priced corn. But so no, it's just going to make you guys even better at what you do. When corn prices dip in the fall, you're going to have to use these resources, futures and options, to lock in your feed needs. You don't probably want to go hand to mouth all the time. So it's going to actually have a positive effect on cattle longer term.
Okay, we got one more for you. So over the last few months, there's been cattle moving from the Dakotas into Canada for shipping. Any thoughts on that? I assume that has some to do with the new trade agreements and stuff, but
Right, right. No, I don't know a whole lot about that, to be honest with you. They go back and forth a little bit. The same with the lean hog markets. We get some ice wing pigs out of Canada. That has to do with currency issues and everything else. It gets a little confusing. A lot of times when you look at the cattle on feed report, sometimes I'm bullish and I'm like, where are these cattle coming from? And I find out they're coming up from Mexico or they're coming from Canada and we're feeding their cattle. So that's what we do is we grow the corn here and then we bring the cattle in to feed. So that's about all I know about it actually.
Okay, one more here. What are your thoughts on the Pause Act that was just introduced in Colorado?
I'm not even familiar with that. I'm a little embarrassed to say. Do you know what that is about, Lee?
I don't. I have to admit, so.
Well, yeah, instead of me trying to act like I know what I'm talking about, what we'll do is I'll let the guy asking that question can maybe type a little bit more into either the chat session or something, and we'll go into that.
Or we can circle.
We'll go into that in the next segment, maybe.
All right, I think we're good on questions then.
All right. Well, sounds good. Thanks for those questions, guys. It's different doing presentations this way. I know I love walking around the room and talking to guys and seeing their face and their interaction. And I like you guys stopping me halfway in between, but this is just something that I think is going to stick because we'll end up with a lot more participation and a lot more viewers by these Zoom meetings, I think. But I appreciate those questions. Otherwise, it gets boring just listening to me talk. So let's go into the wheat market here. Wheat stocks are still healthy. Let me say in quotation marks, healthy, right? The stocks to use ratio at about 35%. It's still high. I'm talking corn and soybeans in the single digits for a stocks to use ratio. So 37% is pretty high. But look at this, guys. We're coming off the highs. That's very good. I think the last time I was up there and talked to you guys about wheat, I think I promised wheat's about 2 years away from a bullish story. Well, that was probably 2 years ago, I'm guessing, at least plus, and now I'm going to tell you that wheat's about a year away from a really bullish story, unless we just don't get any rain in North Dakota. And speaking of North Dakota, let's look at the hard red spring wheat. Stocks are still fairly high here, and that's why the market can't quite take off. We're still, because of our stocks are still high, we're still a follower of corn and soybeans. But like today, we actually had a bearish report for wheat, but we did rally higher because we're following corn and soybeans. Hard red spring usage, though, is actually higher. So that's a good thing. We're using more of it up. I think eventually we'll be shipping more of it out. It depends on China's demand as well. This is, speaking of shipping it out to China, here's a look at our exports. They have been increasing over the recent years, and I think that continues. One of the reasons why is because we have the higher protein, right? That's always our claim to fame. And protein is really what's in demand here recently. Like I say, spring wheat exports have been good compared to like Chicago wheat exports, who have been trailing off here a little bit. Planted acres, of course, what we come up with today, just under 12, I think 11.7 million acres. Sorry, of course, not quite enough time to update all these charts. So acres are down year over year. That's bullish, at least initial thought here. We had September wheat up 10 cents a day to 6.29. So we did get a little bit of pop off that news. Don't hold your breath on having less acres, I guess. I'm just a little bit worried because of the weather that we've got right now. It's just going to be a beautiful weekend. If it wasn't for Easter being on Sunday, I got a feeling there'd be a lot of farmers out in the field. There still may be a lot of farmers out in the field. I think we're going to get these acres back up a little bit closer to 12, but we will see if soybeans rally to 17. That's going to have something to say about it as well, right? Here's a look at the world wheat stocks. This is where we get to have a little bit of problem. Still very high, but China's feeding much more than anticipated. And in something about China that I should bring up, look at these numbers over here. So we're saying the world stocks are at what? 300 million metric ton, basically say. Well, China's ending stocks, what they have is about half of the world's ending stocks in wheat. So literally, we're suggesting, or USDA is, that China holds half the wheat in the world. Okay, I guess. But what's China been doing lately? They've been buying wheat like crazy. So even if they've got half the wheat in the world, if they're buying it, doesn't mean that they need more of it. So maybe we don't have as many wheat stocks out there as we think. You know, maybe we can take the China stocks down and the world stocks are down. And that might happen in USDA reports down the road. I'm not going to promise you that, but really when it comes to China, always guys, just don't listen to what they say or how much stocks they have. Pay attention to what they're doing. And they're buying a lot of wheat recently. Now here, sadly, it hasn't really all been from us. Australia came in with a huge crop of wheat, big rebound from what they've had. They've been dry, got a ton of rain this year, produced a record 33 million crop. There's their exports, of course. So big time exports from Australia. So even though China and Australia are having a trade war, just like we had a trade war with them for a while, China said, no, we're not going to buy your wheat. We're going to put tariffs on it. And guess what? You know, they said, no, we need it, and you're cheap and you're local, and they bought it anyway. But it's good. If China, what if Australia has a problem eventually? They're going to come somewhere else for wheat and buy our wheat. Finally, production is actually below usage for the first or second time in 8 years, I think I counted. That's a very good thing. So as long as demand stays high, production doesn't go crazy and then have a bunch of record crops around the world, wheat is eventually getting to be a bullish story all the time. If you're kind of wondering like this summer, like what to watch for to know whether wheat prices should go higher or lower, watch European wheat production. Look at these numbers here. Europe is producing, you know, around 130 to 150 million metric ton. And what did that chart just show from Australia? They produced 33 million metric ton. But Australia, we're always talking about, right? We're watching their weather. Has Australia got a big crop or not? Well, they're peanuts compared to Europe. Europe had a decrease in production this last year. A little bit drier there. They've had some recent rains. But if Europe has a problem, your wheat prices will go higher. What are the funds doing? Okay, I keep talking about the funds all the time, but I think they're that important. Here's the good news is through all these years, actually, wheat was kind of the, I don't know, redheaded stepchild, you'd say, or something. Everyone wanted to sell wheat versus other commodities. You know, a lot of traders, a lot of spec traders like to spread trade. They'd buy soybeans because they're bullish soybeans, but they didn't want to be just naked long soybeans. So then they'd sell wheat against it. So for years, funds just sold wheat. And it was also because we had big supplies, right? Well, they're finally starting to get long in this market. Now, if I would update this chart a little bit, from what I know from this week, I think they're barely long the wheat market anymore. Here's a look at Canada wheat production. Pretty large crop in 2020. Should be lower in 21. And here's one of the main reasons why. This chart might be a little bit harder to see, but this is canola prices, right? You guys up there have some canola, I know. You're rallying up with the rest of the veg oil markets, the sunflower oil markets. That's why soybeans are rallying too. Soybean oil on fire. I look for that market to make new highs. As this demand grows, you'll just gain a few acres there. But you know, Canada, they're just like us too. I grow wheat, I'm used to it. If that's what they're going to grow, they're going to grow it again. But you could see a little bit of a decrease there. Look at a continuous new crop spring wheat chart. So this is just like I showed you before, this for cattle, but this is every year's September wheats for Minneapolis over and over again. I think I forgot a line in there, it looks like, or the line shifted on me. 650 has been a resistance point that I've been watching. And when we did get up there, we were lucky enough to get some sales on. Not smart enough to keep the sales though. We sold some wheat on the board. When it dove down, we took some quick profits because I'm still bullish the soybean market enough that I told guys, just take your quick profit and wheat's going to follow soybeans up later. Everyone's probably looking back here to some of the 2010, 2011 rallies. You know, that was kind of the year everything kind of went up. It wasn't really the drought year of 12. Remember, we didn't have the drought in 12, did we, in the Dakotas? At least not in northern South Dakota. North Dakota wasn't too bad, so we had crops then. But, you know, back to the whole inflation thing, you know, wheat will run with everything else if there is an inflation play. But like I told you, I don't know if I'm smart enough to tell you whether there will be an inflation play or not. Here's a look at the supply and demand table, an updated supply and demand table. Here's what USDA has for January. I think that's the old crop, so that's the 2020 supply and demand table. 836 million bushels for an ending stock. Now, what you do with that ending stock, of course, that comes up into carry-in for the next year, right? Here's the USDA outlook form they had in February. They had us at 45 million acres of total wheat, with about a trend line yield and ending stocks of just under 700. So that's the great thing, is with a little bit lower demand, which is maybe questionable now because that feed number maybe needs to be bumped back in. They still had our ending stocks decreasing this year. That's what I mean. We're maybe just 1 year away or 2 years away from being really bullish wheat, or wheat having a story. So having me back up in 2 years, and if it hasn't happened yet by now, then yeah, I'll be buying the beverages or whatever after the meeting. So, but I think it's coming. All right, so for today's report, we had a trade estimate of 44.971 million bushels, million acres total planted. Ended up at 46.4. That's the number we do know. The rest of these numbers are just guesses I wanted to throw in there just so we could see, well, what does that 46.4 mean? If we yield 52, ending stock might increase to 7 or 12 from the USDA outlook form, but not bad. As you can see, I've got demand numbers higher. These are all my estimates over here. I'm still at about that 45. I'll maybe adjust that this afternoon as I study the report a little bit more. I had an ending stock a little bit lower. What if yield comes in lower, 49 bushels, 528? Oh, you drop that yield to 45, you know, it's quite a bit different. Here's the thing is, I'm talking wheat, all wheat, Chicago wheat, basically, everything mixed together. Spring wheat, of course, if you guys don't get the rains up there, and northern Minnesota doesn't get the rains in Montana and parts of Colorado, spring wheat can take off on its own. So be flexible with wheat. I'm bullish wheat, but we all know when you get 650 and higher, we haven't seen that price in a long time. Maybe use that put option strategy I've talked about and buy a put, and then if it goes higher, roll it up and do it again. Talk to your bankers and the loan officer about that. I'm sure they can help you with that as well. It's just probably a good strategy to have. Wheat, you know, just the second we think it's going to $9, it usually falls down on its face. So 650 and higher, you can sell your wheat there. But yeah, have some flexibility, so maybe some call options with it. Do the cash sales for a while, but don't get crazy on it. Any questions about wheat that popped up?
No questions about wheat. I did get some clarification on the Pause Act here. I'll just fill us both in, I guess, but it's protect animals from unnecessary suffering and exploitation.
Oh, okay.
So I probably did hear some rumblings about that, I guess, and hadn't followed up, and you maybe are the same, but that is asking for basically a life cycle to be determined, and then they want a certain percentage of the lifespan before anything is slaughtered, which obviously wouldn't be a good thing for livestock. But
no, I hope something like that would get squashed as it gathers more momentum. The cattle market, it seems like us feeders and cow-calf guys, we just always take a black eye, don't we? In the media, we got to take care of the animals the proper way too. And if anyone would come out on, they'd realize we are. You get some of the bad videos, that never helps either. But probably doesn't help the market. I guess to answer his original question, what does it do for market? But yeah, since I haven't heard about it much yet, the market hasn't heard about it much yet. If something like that gets passed at a time when inflation's hitting and demand's high, we don't care. It's kind of like, I'll compare it to spring wheat discounts. When you have a lot of spring wheat in supply, guess what? Yeah, we find discounts everywhere, don't we? Especially at harvest. And then when the supply's low, and we don't care anymore. It's okay, just bring it on in. And I hope something like that happens. So not really answering his question, but he can contact me later. We can talk more about that.
Right. Hopefully that doesn't get very far.
Right. No, I hope not. Well, all right. If there's not questions about wheat, and if you have questions later, guys, just type them in. We'll come back to wheat and talk about it. To sum up, wheat, generally bullish wheat, but don't get so carried away. And I know what happens is you're going to plant wheat up there and it's dry. You're going to say, well, I can't sell because I don't know what I'm going to raise. Well, hello, that's kind of what futures and options are for. You don't have to deliver on those. soybeans, of course. So I can help through with that, or any broker can. Let's look at the soybean market here. Hey, I'm going to continue this bullish theme actually, and this is really the king of the bullishness here is the soybean market. The soybean market could be bullish enough to lift all grains in 2021. All winter long, I was kind of sitting here pounding the desk saying we need to ration demand. Ration demand means you need the price to go high enough so that you lose demand, right? I said we have to do that, and we got to buy acres. What did we find out we did today? Evidently, we didn't buy enough acres. So I think the soybean market's going to be a little bit of a rocket ship in the short term here. Probably lift everything higher, let you sell your wheat above 650, let you think about selling corn probably above $4.85 to $5. Look at the stocks situation. It's just very tight. Remember me mentioning spring wheat stocks are fairly healthy at like that 37%. We're about 2.5% for soybeans. And that's looking at the old crop stocks. New crop stocks, believe it or not, with the planted acres they told me, I'm down here. We're below the 0 bar. So that's a problem we'll have to fix. Let's look at soybeans, last year supply and demand table, right? I love these USDA report days. They're fun. Back in the planting intentions report, they had 83.5 million acres intended to be planted there. Okay, at one point in time there then, with a large yield and the acres stayed the same through the June report, or very close to the same, we thought we had an ending stock of 610 million bushels. And then it got interesting, didn't it? Back in early August, myself and any other broker who likes to actually be honest was bearish. Everything looked doom and gloom. It looked like we were going to have low prices. So we were telling guys to sell the market, weren't we? I did on my farm too. I was 100% sold on soybeans. Here's the lucky thing, or I'm going to say lucky, but it's also the educated thing on using futures and options. I was 100% sold on the board. I was lucky that way because once this market started to move higher, we had the derecho event. This yield drops down to 51.9. I went, whoa, this soybean market has something going. Funds were short, so we knew they had plenty of room to go long. So we exited our short positions, and I was able to hang on to our cash soybeans until we got a little bit higher price. So I know a lot of guys don't use futures and options, and that's fine. You don't have to be a successful farmer, that's for sure. But a year like last year, it was a good example of it's easy to click a button and get out of them, and thank goodness we did. Now, I still didn't hang on to my soybeans until today, right? I still sold them too cheap, I feel like, but at least I got out of those short positions because every broker was bearish back then. And why were we bearish? We didn't have demand and we had a big crop coming. The supply started to get tight. Look at where we ended up at 50.2, which is still a very good yield. And then China started buying, right? And the demand started to increase. As you can tell, here's USDA's current estimate for supply and demand for old crop at 120. That's back to that stocks report you saw there, that chart. My number's at 81. Crush is higher than USDA's forecasting, I believe anyway. I think exports are going to be higher. We've already shipped out a lot of our soybeans. So I've got a really low number there. We might run out of beans. We won't run out of beans. I'll tell you ways how we can make sure that doesn't happen. If you look at US soybean days of supply, we're down to about 10 days of supply. So that'd mean like at the end of the marketing year, which is the end of August for beans, right? We'd have left over about 10 more days of supply. Here's what the market starts to do to correct things like that. If you look right now, at least in my area, I'm pretty sure it's the same way up in your guys' area. There's $1.65 a bushel difference between old crop and new crop right before harvest. Well, what are farmers going to do then? And it's a little harder in beans because they're daylight sensitive, but like in corn, we've got about a 65-cent difference in price per month there. Guys are going to plant it as early as they can. They're going to try to harvest it, and they're going to try to bring the new crop into the old crop marketing year. So just little ways we get around having holes. We won't run out of beans. Here's a look at the soybean exports. Right now, USDA already does have us at a record amount of export demand. I just think they just got to be a little bit higher than that. Not a lot, just a little bit more. The March 1st stocks report came out today. Sorry, the chart wasn't updated by our company there that we get a lot of our charts through, but I just drew an arrow down to where it is now for the March 1st. So a large decrease in soybean stocks year over year. World soybean stocks, the same thing, quite a bit of a decrease. And look at that stocks to usage ratio really declining there. Argentina soybean crop is not a record, of course, and actually, I think we're going to have to lower that a little bit. They went through a bit of a drought that I was surprised during the winter that the market didn't get more excited about. That's when I thought, beans should be at $15, $16, to be honest with you. I thought it could run, but Argentina had a bit of a drought. Market didn't seem to care too much. I think we'll decrease them maybe 2 million metric ton. Here's a problem. Here's a look at Brazil's chart. They're going to produce a record, and they were going to produce a record really no matter what the weather was because of how many acres they planted. I'll decrease Argentina maybe 1 or 2 million metric ton, and I'm just going to increase Brazil probably 3 million metric ton from the current forecast. They've got a big crop. Yes, they had some quality issues come out of there, but it was minute. What do you do with some moldy beans? You just blend them with good beans, and they had plenty of good beans to blend with. China's import demand, it just continues to keep growing here. This was the trade war, and that's when they used a lot of the reserves, and now what we're finding out is they did need us. If we would have held out long enough, I think the trade war, we were going to win. Maybe we did win. I don't know. That's, again, not going to go down the political route today, even though everyone else is on mute. I'm still not going to take advantage of that. They're back in now buying beans, 100 million metric ton expected, and I think they're going to keep that. A lot of people always ask me, well, doesn't soybeans, China will come in and cancel them, right? Yeah, they can at times. This is a look at the export sales number. We've already forecast or sold basically 100% of what USDA was projecting we'll do this year. That's why my export demand is a little bit higher, way ahead of the normal pace. But won't China come in and cancel? Well, this is a chart that shows how much we've shipped out already. And this chart needs to be updated just a little bit more because after last week, we had a big export shipment. We're right near that 100% already. Once they're shipped out of the country, they can't be canceled. They can move them to another country, but they're out of the country. So no, you're not going to see, you might see China cancel just a tiny little bit at the end, but it's not going to matter. We've already shipped so many of them out. So this is a problem. This is why I'm so bullish on soybean market. What we might have to do then, when you look at an S&D table, look at this import line here. All right, in February, USDA had us at 35 million bushels for imports. Normally, in a normal year, it's around 15. What they're assuming, and what I'm assuming will happen too, is we're going to actually buy beans from Brazil, and we're going to ship them up to North Carolina, where there's a lot of hogs, and they're going to feed them. Instead of putting beans on a train from Illinois or from North Dakota or any of us, they're going to buy them from Brazil. We're just going to run out. So, but to buy beans from Brazil, what has to happen, guys? See, this is where I'm used to still talking to a live audience and I can answer questions out loud. What's going to happen is you need higher prices to get there, to buy those beans, all right, and bring them up from Brazil. This number might end up being 50 million metric ton. And then what does that do? Well, that creates my 181. We'll get it back above 100, and we won't run out of supplies. All right, here's what happened today. We had the trade estimate of 89.996 million acres. Came up with 87.6. A lot of the early trade talk was anything below 90 is going to be bullish beans. Well, that's way below 90. Isn't this kind of fun? You can see why I'm bullish beans, right? So that's what USA gave us today. The rest of these italicized numbers are just numbers I'm plugging in there just so we can kind of see. Obviously, I've got my 81 for carry-in coming in, and I have demand strong, but why wouldn't I? We end up with a negative carryout right now, the way things look. Can't have that, of course, and that's with a 51 for a yield. I don't know what else to say, guys. It's a bullish setup for the soybean market right now. Now, skip over to the right. This was my guesses for today's report, and that was still, I thought, bullish, but I had more acres. What I think ends up happening in June 30th, on June 30th, USDA will come out with their final planted acres. You know, we reported to Farm Credit, we reported to your crowd shoots agents, they reported to FSA, and we find out the real numbers. I think you're going to end up around 92 million acres. Imports for the new crop still might come up too, but we'll get that back to normal. If you have 92 million acres and a 51 for yield, surprise, surprise, you'll have enough beans at the end. I really took away from this morning's report was how this year is probably going to play out. Okay, now this is being recorded, so you guys can all come back later and tell me you were way wrong, and that's fine. You're going to see a run up in prices in the spring. It's going to be more like a normal year. You're going to have high prices in the spring to guarantee these acres all get planted. That way we don't take prevent plant this year if it's even close to an option. And you're going to have higher acres. And then what happens is normal weather, I'm assuming normal weather, June 30th, you get these bad bearish report. July 4th, you get some rain and the market's trend lower from there on out. But the nice thing about soybeans, it's hard to put a really bearish picture. But I'm not saying don't sell anything. We produce a crop to sell it and make money, right? I'm about 30% sold on soybeans right now, and I'm going to do my best tonight to buy some of those beans back, but continue to sell as it goes higher. The acreage number, yes, we can plant 92 million. That would be a record. But to say we're going to be at this 87 just seems too light to me. Where are the funds at right now in the soybean market? As you guys probably already guessed, because we've rallied a lot. They've been long. They've actually been trending out of these long positions here lately. But after today, they're going to jump right back in and continue to buy. Continuous November soybeans was looking rather bearish in the very short term here before today's report. Now we're back up to that 1256 area. I made this circle months back when we started to realize how tight we're going to be. My initial marketing plan, which I make usually around Christmas time or the 1st of January, or after the January USD report, was to sell new crop beans from 1125 to 1450. Pretty wide range, right? In small increments. We're only about 30% sold right now. But if you have to ration demand, you can, I can't believe I'm going to say it, but you can have a rally up to $17.50, $18 if you need to ration demand. And I just got done harping and saying we need to ration demand. So what I was hoping this market was actually going to do today, guys, was have a bearish acreage number. Let's go lower. And then I was going to buy what we call like courage calls. That way we can sell the market when it does rally, because I just harped about we still need to sell for profit, right? But the courage calls will stop margin calls and they'll give me the courage to sell my new crop. Remember, we're looking at profits we haven't seen in years now, too. I know I don't have to tell anyone there in the bank. We need some nice profitable years like this, and it's going to be a lot of fun this year. So let's talk about some of the soybean strategies. I said buy a 1450 August short dated call. Well, what are short dated calls? The new crop contract is the November contract, right? Well, if you go to buy the November put option, I'm going to tell you a price that will just knock your socks off. You know, it's going to cost like 70, 80 cents to buy put options out there right now. Nobody wants to spend that much. The reason they're so expensive is because all the time value it takes to get to November. You can buy off the November contract board, which is your new crop, but have a shorter time frame on it. So if you want to buy puts and cheaper, you go here. Here I'm talking about call options. But instead of going all the way out to November, you buy an August short-dated new crop call option. So that's going to expire about the end of July. Of course, so I'm short the board. I'm hoping it dips down. I'm going to buy these call options to give me the courage to sell my crop once it goes above 1450. I probably was quick going through my trade, or where I'm selling is from 1125 to 1450, right? If I buy 1450 calls, then if the market continues to go up, I'll still make money then. And at least I won't have margin calls on my straight short positions. That's why I like those August short dated calls. They expire about the 3rd week in July. By then, I feel like we'll know a lot more about this crop, the size of it, and maybe we're high enough I make some money on those and then just ride it lower. Remember, I think after July 4th, I think we're going to go lower in the fall. You can sell up to 50% of your cash expectations. You can go even beyond that with your crop insurance there too. Here's a good thing about soybeans. I don't have to remind anyone about the horrible soybean basis we had in North Dakota. It trickled down into my area, Northeast South Dakota as well. That may kind of be a thing of the past, unless we get in a trade war with China again. We already have very good basis for new crop soybeans, and that's because we have a bid out to the P&W again, thank goodness. I think we'll get back into where China's buying from us much more consistent. Question. questions on soybean, and while Lee looks for a few questions, I'm going to say just a little bit about China and their feed demand. Remember last time up there, I talked a whole bunch about hogs and ASF, right? Which was kind of silly, I get it, because up in North Dakota, we don't have a lot of hog facilities. I don't have many of them down here in my area. Okay, ASF kind of came and went, and now it's still there again. But what it did is, remember I showed you pictures, in China they had all their hog herds were just mom and pop farms they would literally feed table scraps to them, right? Okay, well now a lot of those pigs died and they're able to westernize their hog facilities. They're these huge monstrosity buildings now. But instead of feeding table scraps, now they're going to feed what I call a westernized feed program like we have. It means a lot more soybean meal, a lot more corn, a hotter ration. They get the pigs in through faster. That means more soybean meal from you guys in North Dakota, or more raw soybeans stripped out, and then they'll crush them there themselves. So that demand should be very strong. I know in the listening area we're talking to here, I'm talking more to the guys probably in the south and east part that have more corn and soybeans, but you guys in the central and even further west, the beans are going to be a profitable tool for you guys moving forward.
No new questions on the board here. Just one maybe from me that I guess in the soybean market, it seems like South America and Brazil are quite a few of those countries, I guess, in South America have a fair amount of impact. I haven't really watched their weather patterns, but do you see them going to soybeans? I guess I'm not sure. In our neck of the woods, I think because soybeans aren't real strong on insurance guarantees because of our yields, I think that might be a little bit of a limiting factor if it's dry for another month or so. I'm not sure in South America, that there is insurance and that kind of stuff. So I would think they would go stronger into soybeans. Any thoughts on that?
I tell you what, they're going to go stronger into both corn and soybeans, sadly. They're making so much money right now. It pays to have some more deforestation done and expanding acres. That's why Brazil was going to have a record soybean crop, really almost no matter what their weather was like, because they were just gaining so many acres. And believe it or not, it's better for us to have low prices in our fall season because that'll hinder them from expanding those acres even more. You had a good question about, do they have insurance? I don't know if they do. I think it's more kind of Wild West.
Yeah, I don't think there is that I'm aware of. If there was, it certainly wouldn't be subsidized like what we have. So I'm imagining not.
Right. And remember, when we talk South America, it's all about the currencies too. With their currency play the way it is, they're just making more money than we are, even as farmers, with these high prices. And as our prices go up, they sell off the Chicago Board of Trade. So they're going to make more money as well. So, and that's okay. I mean, that's how supply and demand is supposed to work. If we don't raise a big crop this year up here, it'll be on Brazil and Argentina to raise a big crop. Okay, well, we'll keep going here. I promised Becky I wouldn't talk too long, but here I am getting long-winded. But and brokers tend to do that. That's just the way it goes. Let's look at the corn market here. All right, this one has also really changed from last spring, right? In May, well, first off, believe it or not, last March, we intended to plant 97 million acres of corn. And what was the corn price then? About $3.70 on the board. Kind of why I thought we'd have 95 million plus this year. We were $5 this winter. I still kind of am shaking my head going, oh, those acres are going to be higher. But anyway, in May, with those higher acres that we intended to plant, which I knew was wrong last year because I was looking out my window going, we weren't going to plant anything. We were just too wet, and so was a lot of areas there in North Dakota as well, of course. But we had a $3.3 billion for an ending stock. Is what we projected. I mean, talk about a bearish outlook. And then the same thing, we got to that August time frame, the derecho hit, and we dropped the yield. It hit earlier, but they didn't drop the yield until September. And then China started to step in a little bit here too and started to buy more. Look at the exports picking up. Crazy flip from where the other thing that happened is, look at this number called the carry-in number, okay? So we have a quarterly stocks report like we had this morning. USDA started trimming 2019 crop to 2018 crop. And yes, that frustrates everybody because farmers basically knew that, right? We were all saying the corn crop isn't out there, but USDA kept saying it was. How that happens, the biggest reason is that it's a test weight thing, actually. Test weight and moisture. And we got to remember as farmers, we're filling out these surveys. A producer goes and fills a 30,000 bushel wet bin with high moisture corn and low test weight. And he's like, well, yeah, it's full. That's 30,000 bushels as he puts in the survey, right? And then by the time he takes it out, he runs the fans and it dries down. What does he get out of it? Oh, 27,000. So in the light test weight years and high moisture, it's just a problem USDA has. They need to figure it out, and we need to figure it out too. We have to be a little bit better about answering those surveys. But anyway, I'm rambling again. We just had less corn coming into the marketing year than we anticipated, and then we had the derecho, and then we had demand pickup. Just an unbelievable storm. So we went from 3.3 billion in May, and wondering if we can move back into with our parents if we're going to keep farming, and then we ended up. I'm at a 2.259 billion. Dramatic decrease in ending stock and why corn prices are going sharply higher. World corn ending stocks continue to decrease. Here again, look, world stocks are on what? 285 million metric ton. China's ending stocks make up about 2/3 of that. They're at 190 million metric ton. Again, look what China's been doing lately. They've been buying corn like crazy. So aren't world stocks even tighter than what I just showed you then? If China has it, 2/3 of it, but they're buying it left and right, almost up to 25 million metric ton, maybe we don't have as much corn out there in the world. And that's really why the corn market's been rallying, guys. We're not crazy tight in the US. We're not like the soybean situation where I'm afraid we're going to run out. We'll have enough corn, but boy, the world stock situation must be pretty tight. So that's why China's been in buying from us. And I say, you don't buy 25 million metric ton if you have plenty of corn yourself. Brazilian corn production, just like Lee and I were talking about, it's just they're making so much money, they're going to keep producing it. But boy, do we have a story coming here. I think we do anyway. As many of you know, Brazil, they plant some corn, they plant a lot of beans, a whole lot of beans. And then as they harvest their beans, they got their full season corn, they've harvested that. They use that for their feed usage. But as they harvest those beans, they start planting corn behind it called the second crop of corn, or the safrinha corn crop. They want to get those beans off as soon as they can and get that corn planted because the rainy cycle will end as you get towards the end of April. Really almost even middle of April. Well, you guys all know you don't want corn to run out of steam as it starts passing or get hot and dry. The later they plant their corn crop, the better chance of a production shortfall. The only thing is the price is so high, I bet you they planted a lot of acres, but we'll find that out in the future here. So if I'm saying world stocks are tight, we could have even good weather up here in the US and still have a rally in the corn market because Brazil has a second crop corn production problem. So stay tuned for that. US ending stocks, like I said, it's tight. I mean, we're decreasing it. As you know, USDA is at 1.5. I'm at a 1.25, so I'm a little bit lower than they are. But we're not running out. But just remember me saying we were thinking we were going to be at 3.3 billion? That's not even on this chart, guys. So we went from having a horrible situation to running out. So I totally understand why the cow-calf, the stocker, feeder guy, the feedlot guys didn't buy a bunch of corn because it looked like we were going to have plenty of it. Always watch your basis. That'll tell you really what the current situation is, or the real situation is. Here's a look at the corn stocks as of March 1st. Again, I was not able to update this slide, or our company wasn't today, but it's right down about here. Like I said, so corn was the only one that actually had the decrease versus the trade estimates, so a little bit lower stocks. And that's the third quarter in a row. Whether you're going to chalk up and say that demand was higher than anticipated, or are we still taking off from the 2019 crop? Doesn't matter to me. We just have less corn on hand than we thought. U.S. corn planted acres, like I said, where are we at? We're just only up a couple of percent from last year. Look for that to end up being higher by the time we get to June. High prices usually do that. Here's a look at the corn yield too. And I totally get, like North Dakota, you guys have been pretty dry, but remember, of course, being dry in the winter, that's a good time to be dry, right? To move as much snow as we have the last couple of years. But because it's been dry there, it was dry in the Midwest until the last couple of weeks. I've had a lot of people talk about below trend line yields. The whole plant in the dust and your bins will bust. I'm a pretty big believer in that. Why? Because the last 20 years, I usually do a study on one field of our farm and I plant in the mud. And trust me, it's a dud then when you mud the crop in. So you get that good seed to soil contact, you get some rain afterwards. I think we bounce back. The reason I'm rambling and talking about that is showing this corn trend yield. We're actually kind of due to bounce back above it. And I think if you plant it early and you plant a lot of it, you will. Now, corn market's going to rally today sharply, tonight maybe a little bit too, but eventually, I mean, I've got a client in southern Minnesota, guys, who texted me a little bit ago. He's got 200 acres of corn in the ground and also 150 of beans. They're going with two planters at the same time. If that crop is planted at a record pace, you know what happens to the market, right? We start to think, oh, Jesus, maybe we have more acres. Oh, maybe the yield's a little bit higher than anticipated. So don't get too bold up on the corn market. All right. So trade estimate was for 93 million acres today, ended up at 91.1. The rest of these highlighted or italicized numbers are, again, just estimates I'm throwing in there. They're not from USDA. But I had to put something in just to see, well, how tight is that? Oh, 1.3 billion. Again, not you have to run to $8 corn by no means, but tighter than we sure thought it was going to be. Now that's using, my numbers of a 2.2 carry in. So we'll see what USDA says later. That was my estimate for today. It's quite a bit bearish. I'm going to have to adjust that. What could happen in June, though? And I had this column in here before this today. I think we'll find some of these missing acres. You're going to read a lot of reports today about missing acres. If we get up to 93 million and the yield is 181, well, then our ending stock is 1.6, just about the same as we are this year. So remember me talking about the guy who had the questions about the feed. Don't just assume that the corn's going to be $6 all year. If you have to during the summer, you're going to have to just go hand to mouth. Don't lock in high price corn for new crop yet. I think it can be lower priced. So here's where I'm going to talk a little bearish about the corn market. And I'm not saying that it can't do an amazing run with inflation and everything else, but I think we're going to produce a big crop. You tell farmers they can't do something, and usually we do it, don't we? My initial marketing plan for new crop soybeans was to sell between 475 and 525, basically kind of that big circle area, because I thought really what I thought was going to happen is soybeans would drag corn up there. Turns out China's buying more than I anticipated. I didn't like banking that China was going to buy all of this corn from us. I was like, boy, I can't believe we're falling for that sucker punch. But no, it was the truth. China's buying a lot more from us than anticipated. I recently just had to increase my ending stock number by 200 million bushels. That's why I'm lower than USDA's 1.5 to 1.25, because yeah, China is buying it, and I think USDA will have to lower it as well. Okay. Big news today, less acres. I still like selling from 475 to 525. Well, these corn today is 477. So go ahead and continue to make those sales there, and look for lower prices can fall. But that all being said, you might want to look at some type of courage calls or something as well to keep that flexibility. Yeah, everyone can probably see the number over here, right? $8. It's obviously possible. I don't think it's likely this year, but if beans are going to take off, it's going to drag corn up with it too. What I was looking to do was I was hoping the market was actually going to be bearish today, dip a little bit lower. I was going to look at those 525 August short dated calls again. So I'm going off the December board, but they're not horribly expensive because of the time value. I was going to try to get those for about 10 cents. After today, those are going to be a little bit more expensive. But why am I buying the 525? Well, because I'm going to be sold out by then. Now, I'm probably going to tweak my marketing plans just a little bit for our clients, and maybe end up selling at 550. But I got to tell you, I know how much my farm makes in this area, and my bank will let me farm next year if I sell in here. So I'll continue to look to sell there. Hedging markets. I'm just going to kind of summarize a little bit here. What I've learned the past 20 years. You can just sell the grain after harvest. Nothing wrong with that. That's basically, for the most part, the way my dad did it. Most farmers out there still do it that way, and that's completely fine. You do that with cash contracts. The one thing I will say about selling grain is if you wait on your farm to know exactly how many bushels you have to sell, you can probably take about $1.50 off the corn high and $2.20 to $2.50 off the soybean high. Because why was the market higher? Because the market didn't know what kind of crop you guys were going to have. You know, the drought monitor shows it's dry in North Dakota. As you guys get going this summer, I'm going to call some of my North Dakota clients, and I know I'm going to get this response. You know, I'm going to say, I think we need to sell some beans up here. It's a real good profit. And I'm going to hear, well, I don't know how much I'm going to raise. I know, but if you wait until you know how much you're going to raise, trust me, the market's going to know before you do, and the market will probably be down. So I was, yeah, of course, I'm a believer in futures options, right? Otherwise, I wouldn't be doing this job for a living. So it is kind of a fun job though, too. So yeah, you can do cash contracts, options, futures, a ton of different options. On the next slide, guys, I'm going to leave my contact information down there too if you have questions. This is kind of just your normal disclaimer I have to show, right? Hello, compliance department. They'll have to probably watch this. So you gotta always keep that stuff up there because it is very risky. We all know that. Look at what happened today. So that's what I've got for a presentation. So Lee, if there's any other questions or comments or questions you have for me.
We do have one more question that came in going back to wheat, and it's regarding basis fixed contracts.
Mm-hmm.
Somebody is wondering about locking in the current basis on hard red spring wheat, which is pretty favorable for June right now at 35 under. Have you done any work on like the trends of that, historical trends on basis and more of a bull market?
I have. We do track basis here, of course, you know, for more my area than up there, but I'm just going to, for this question, I'm going to assume your basis is the same as ours. Historically good. Yes, lock that in. I think that's a great thing because what happens if it starts to rain? What did I just talk about? Once it starts to rain in North Dakota, what do you think is going to happen to that basis as well? And it widens out because then everybody knows they've got the crop and they'll start selling more of it. So no, I think that's good to go ahead and lock that basis in. You know, the only thing about basis contracts is you do have to deliver, and then you're locked into whatever discounts that elevator has at the time. Myself personally, I'm more of a, well, of course, you sell the board guy. I like storing the wheat, even if it's just until December, January, and then dump it back out. But that's hard to do. I understand that. So, nope, I like that. The basis is very strong. You're going to hear your elevator say this, though. They're going to say, it might get better. And that's true. It might get better, but it might get better by, I'd say, about 10 cents. I'm worried about it getting worse by 50 cents. And I think the guy asking that question is too. In fact, our basis did get worse for a new crop spring wheat this last week by about 10 cents. And usually how basis work, it kind of runs through the territory. So expect that coming in your guys' area real soon.
It looks like that's all we got. Thanks so much, Dwayne.
Yeah, hey, thanks for having me. Thanks, Lee. Thanks, Becky. Thanks everybody at Farm Credit there. I enjoy talking markets with you guys. Yeah, hopefully next time we can see you in person.
Exactly. Have a good rest of your spring and summer here.
Yes, you guys too. Yeah, if that's it, we'll wrap it up here, guys, and talk to you next time.
Yep. Thanks for everybody who attended as well. Appreciate your support here and like to get at least a few of these meetings done a year to keep people informed. So I'm glad it worked out.
Yep. Thanks. And I'm recording it on this end. I'll send it to you guys. So if you guys want to watch the rebroadcast or anything, feel free to do so.
Yeah, we'll put it out there. I think there's a lot of people even that registered here that weren't able to make it probably because of the good weather conditions here this afternoon after a couple of very windy days.
It's too nice out. I totally understand. I do the same thing here, so that's okay. All right. Well, thank you, everybody.